Ray Dalio is one of the best investors in the world. Ray is also famous for creating the all-weather portfolio, and the big idea behind this is this. Essentially, there's only 4 economic environments. You've got times of inflation, times of deflation, economic growth, and economic contraction. And the all-weather portfolio was designed to do well in all environments. Now, to get access to this, Ray would have required over $100 million, but this portfolio was revealed in Tony Robbins' Money Master the Game. Here are some quick stats on the portfolio. Now, over a 40-year period from 1973 to 2013, the portfolio has averaged a 10% return. In that time frame, it's made money 85% of the time. The average loss was only 1.5%, and the worst loss in that entire time frame was only around 4%. And this is back when the S&P 500 lost nearly 50% of its value. So as you can see, this looks like quite a valuable portfolio. And what else I'm going to do in this video is show you how you can build it with only 5 ETFs. As always, if you find anything useful in this video, be sure to click that like button. That would be much appreciated because every like does help. Okay, sit back and relax, guys. Here is Ray Dalio's all-weather portfolio. Here is what we've got coming up. We're going to break down the all-weather portfolio to start. I'm then going to give you some of my thoughts and insights of what I thought about the portfolio, who it suits and who it doesn't suit. I'm then going to show you how you can build this portfolio with just 5 ETFs. We'll then look at its recent performance, so how has it done over the last year and also 10-year. And then we're going to finish with Tony Robbins explaining the methodology behind this portfolio. When looking back through history, there is one thing we can see with absolute certainty. Every investment has an ideal environment in which it flourishes. There is a season for everything. The all-weather portfolio. Okay, here it is, guys. And it's broken into 5 different asset classes. We have stocks, long-term US bonds, intermediate US bonds, gold, and commodities. And this is the breakdown. 30% of it is in stocks, 40% is long-term US bonds, 15% is intermediate US bonds, 7.5% in gold, and 7.5% in commodities. The all-weather portfolio in its glory. And this is a portfolio that's meant to do well in all seasons. There are only 4 environments or seasons that move the prices of assets: inflation, deflation, rising economic growth, and declining economic growth. So here are my thoughts after breaking down and seeing the portfolio. Firstly, who does this suit? I would say this is a great portfolio if you've got a large amount of money, where if you were to lose 10%, then this would be a serious amount of money. I think it's also an excellent retirement portfolio, so something that you may want to convert to later in life. And I'd say it's definitely a lower risk portfolio. And now, who doesn't it suit? I'd say it's not so good for the younger investor, or if you've just got a smaller amount of money. I'd say in summary, it's a portfolio that does really well in bad times, but it gives you solid performance in good times. On diversification. The problem is, every single asset class that you love will have a day where it drops 50 to 75%. If it's later in life, you won't have time to make up for it. Okay, let me show you how you can build this portfolio with just 5 ETFs. So starting with stocks, 30% would be in the Vanguard US Total Stock Market, ticker symbol VTI. 40% would be in the iShares 20-year plus Treasury bonds, TLT. 15% would be in the iShares 3 to 7 year Treasury bond, IEI. 7.5% in the Spider Gold Trust, GLD. And 7.5% in the iShares S&P Commodities Index, GSG. And if you're living in Europe, you just have to find the equivalent versions of these ETFs. So the question is, how has this portfolio performed? Well, in the past year, it's returned 12.43%. And I think this is the true power of this portfolio. Even with everything that's gone on this year in 2020 with the pandemic, it's returned over 12%, which is excellent. Longer term performance, the 10-year, it sits at 7.44, so it is slightly lower, but its historic performance is closer to 10%. Timing the market is basically playing poker with the best players in the world who play around the clock with nearly unlimited resources. You don't want to be in that game. And let's finish with Tony Robbins explaining the methodology.
This leads to what goes against all the conventional wisdom, which you call all-weather allocation.
Yeah, well, let's talk about that. That's
which stocks only 30%.
Yes.
Explain.
Yes. Well, I sat down with the famous Ray Dalio, right?
Right.
And I prepared for 18 hours for that interview because he's a genius. We spent these 3 hours, and in the 3 hours, when I got to the end, I said to Ray, I said, listen, I really want to help the average person, so I got a question for you. I did this with everyone. I said, if you couldn't give your money to your children, any of it, and all you could do would be give them a portfolio or a set of investment strategies or instructions, and they were going to start over and build it, what would it be? And he said, Tony, I spent a decade figuring that out. All my money's already there. My kids' money is there. My money from philanthropy when I'm gone is there because I'm not going to be here, and I want something that'll do well in the future, and I don't know what the future is going to be. Markets are going to always change. I need something that can work in any market. I call it my all-weather fund. And I said, I'm trying to help somebody that needs to know what to do. I said, you're telling me to make this beautiful chocolate cake, and you're saying, Tony, here's how to do it. Use some sugar. Right? Use some chocolate, use some dairy products. I need to know the amounts. Give me the amounts. He goes, Tony, that's my secret sauce. And that's when he told me, he said, look, 10 years ago, for you to even get in to talk to me, it was $5 billion net worth, $100 million to get in. And he said, and now for 10 years, I haven't taken anybody's money. And so you answered your own question. I said, you're not taking money anyway. It's not going to compete with you. The average guy, he says, is never going to make it talking to a wealth manager. Tell me what to do. Okay, he said, but it'll be complex. I said, I can make it simple. He said, well, I don't want leverage in it. I said, design one without leverage. He goes, it won't be perfect. I said, I don't care if it's not perfect. Your idea of unperfect will be somebody else's idea is the best thing they could do. And they laid out the numbers. We ran the numbers and used the same back testing. So you saw year by year how it really did over the last 75 years of modern investing. And here's what's amazing. Like all weather, similar. In 75 years, it's been right 85% of the time. What's even more extraordinary is the 15% when it wasn't doing well, when it didn't do well, its average loss was 1.6%, not 50, 40, 30, 20. Think of the last 10 years, the 250% hits. His biggest loss in 75 years was less than 4%, minus 3.95. And that was 2008 when the market exploded down to 51%. When you have a 50-50 portfolio,
right,
that's 50-50 of where you put your money in assets. 60-40, 50-50, however you look at balanced portfolio, right? But he said the problem is that's not balanced risk. He said, Tony, when you have stocks and bonds half and half, you're not equal because equities are 3 times more volatile. So your risk is 95.5. He said, so that's why people get killed in 2008. And he said, I try to get this through to people. He said, but all of our people handle it. You manage money for countries, the largest pension funds on earth. He said, but people don't listen. They look at it and go, oh, this is bond heavy. The bond days are over because inflation's going forward. He said, it's not true, Tony. This fund in the 1970s, it was the worst time for bonds and it was an extraordinary time for all weather because it isn't. It looks overbalanced because in order to get the same level of risk, you have to go for more long-term bonds or you have to use more leverage on the bond side.
Here are the allocations
yes.
in the book, which would make a normal person gag, at least initially.
That's
stocks only 30%.
That's right.
Even though the stocks on average are supposed to gain, 9% a year?
Yes, 9.2.
Long-term treasuries, 40%.
Yeah.
Intermediates, 15.
I know.
Gold, 7.5. Commodity, 7.5.
Yeah.
Absolutely counter wisdom.
Here's what's interesting. That looks like your heavy bonds, 40 and 15, 55% bonds. And it looks that way visually in terms of volume you are, but in terms of risk you're not. You're making us here equally weighted. Think of it this way. What triggers things to grow is inflation or deflation in terms of price. Certain things do really well in inflation, certain do in deflation. Growing economy, shrinking economy. And he's figured out which quadrant you need to put each to actually have equal risk. And that's why it's done. Well, this year, this formula is done. It's 1% better than the market. It's in 13 in the third right now. But more importantly, 3 weeks ago when the market dropped and gave up all of its entire benefits for the entire year and everybody's guts were checking, there was no gut check because it went up 1/4 of a point. So the beauty of this is, I'm sure you know, there was a study done over the last 20 years, and the studies from 1993 to 2013, and it's by Dalbar, and they found that the market, S&P 500, during that time did 9.2% on average, just as you said. But do you know what the average mutual fund owner got, investor? 2.5%. That's before tax. Why? Because we as investors always do the wrong thing.
Emotions.
That's right. We sell when we should hang on. We buy when we shouldn't. So the greatest thing that I think that Ray offers somebody the opportunity to do is actually stay in the market. Because if you got 1.6% as your big hit, if 4% was the biggest hit you've ever seen in 75 years, I think you could stay in and you can do what Jack talks about, which is stay in that market through time.
Of course, this means resetting each year.
It's a reset once a year. That's the one, recalibration. So 15 minutes a year and you're in the game.
So there you are, guys. That was the famous all-weather portfolio. And it's a portfolio that's proven to do well in all 4 economic seasons, times of inflation, deflation, economic growth, and contraction. If you did find anything in this video useful, be sure to click that like button. That would be much appreciated, as every like does help. If you haven't yet subscribed, be sure to click the subscribe button below and join us. I do have some great videos coming up that you don't want to miss. I've also done some portfolios of other successful investors. So if you want to see the portfolio of Warren Buffett, Jack Bogle, Bill Gates, I'll drop links below this video. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.